journey and you're theirs too. I swim with tea when they turned in. The staring out to mute and can lend a pole that some kid died.
In our previous example, DeMarco Family Holdings was primarily a holding company that earned most of its income from investments. This example is different. Shine Sunrooms Decks Ltd is an active operating business. Its main activity is designing and building sunrooms, decks, outdoor living spaces, and related construction projects for customers. Every day, the company generates revenue from its business operations. Customers hire the company. Projects are completed. Invoices are issued. And active business income flows into the corporation. Under normal circumstances, this type of income may qualify for the small business deduction, allowing the corporation to benefit from a lower corporate tax rate. But here's where things become interesting. Like many successful Canadian businesses, Shine Sunrooms Decks has accumulated profits over time. Instead of distributing all of those profits to shareholders, the company has retained some of the money inside the corporation and invested it. As a result, the corporation now has a second source of income. In addition to active business income, it also earns passive investment income. This passive income may come from public company shares, bonds, GICs, mutual funds, ETFs, cash reserves, or other investment assets held by the corporation. So unlike our previous holding company example, this corporation has two completely different income streams operating at the same time. On one side, active business income generated by construction projects. On the other side, passive investment income generated by corporate investments. Both sources of income belong to the same corporation. And that is exactly why the passive income grind becomes relevant. The corporation may qualify for the small business deduction because it carries on an active business. However, the investment portfolio can create adjusted aggregate investment income, or AAII. And if that AAII becomes too large, the corporation may begin losing access to its small business deduction. This is a crucial concept. The passive income grind does not target the construction business itself. The company can continue building the same projects, serving the same customers, and earning the same active business income. What changes is the corporation's access to the preferential small business tax rate. And that's why successful operating companies need to pay attention to their investment income. The investment portfolio may appear completely separate from the business operations. But under the passive income grind rules, the two become connected. Investment income can indirectly affect how much of the company's active business income qualifies for the lower small business tax rate. And that's exactly what we're about to calculate. In the next slide, we'll take the corporation's adjusted aggregate investment income and apply the small business deduction grind formula step by step to determine how much of the small business limit is lost. Now let's apply the passive income grind formula to Shine Sunrooms Decks Ltd and see exactly how the small business deduction is reduced. This is the point where all of the concepts we've discussed throughout this topic come together. The corporation has an adjusted aggregate investment income, or AAII, of $110,000 for the year. The first step is to compare that amount to the annual threshold. Under the passive income grind rules, the first $50,000 of AAII does not reduce the small business limit. So we begin by subtracting the $50,000 threshold from the corporation's AAII. $110,000 minus $50,000 leaves an excess of $60,000. This excess amount is the key figure in the calculation. Only the amount above the threshold triggers the grind. Now we move to the second step. The legislation applies a 5-to-1 reduction formula. For every $1 of AAII above $50,000, the corporation loses $5 of small business limit. So we take the excess AAII of $60,000 and multiply it by 5. $60,000 multiplied by 5 equals $300,000. This is the small business deduction reduction. In other words, a corporation loses $300,000 of its available small business limit because its AAII exceeded the threshold. Now let's apply that reduction to the corporation's original small business limit. Normally, a qualifying corporation has access to a $500,000 federal small business limit. From that amount, we subtract the $300,000 reduction. The result is a remaining small business limit of $200,000. And this is the number that really matters. Before the passive income grind, the corporation could potentially apply the small business deduction to up to $500,000 of active business income. After the grind, only $200,000 remains eligible. That's a very significant reduction. Notice how quickly the grind works. An excess of $60,000 of passive investment income has reduced the small business limit by $300,000. This illustrates the power of the 5-to-1 formula. Small increases in AAII can have very large effects on the amount of active business income that qualifies for the lower small business tax rate. And remember, at this stage we have not yet calculated the additional tax. We've only determined how much of the small business limit has been lost. The next question is the most important one. What does this reduction mean for the corporation's actual tax bill? How much additional tax will Shine Sunrooms Decks Ltd pay because its small business limit has been reduced from $500,000 to $200,000? That's exactly what we'll examine in the next slide when we look at the final impact on the corporation's 2019 T2 return. We've reached the final step of the passive income grind calculation. Now we can see how the rules affect Shine Sunrooms Decks Ltd. as actual tax position. Let's start by looking at the corporation before the passive income grind is applied. Under the normal small business deduction rules, the corporation has access to the full $500,000 small business limit. This means that up to $500,000 of active business income can be taxed at the lower small business tax rate. That lower rate is one of the most valuable tax benefits available to owner-managed corporations. It allows qualifying businesses to keep more after-tax profits inside the corporation for growth, investment, and future operations. Now let's compare that to the situation after the passive income grind. Earlier, we calculated that the corporation's adjusted aggregate investment income was $110,000. After subtracting the $50,000 threshold and applying the 5-to-1 reduction formula, the corporation lost $300,000 of its small business limit. As a result, the available small business limit dropped from $500,000 to only $200,000. This change has a major consequence. Before the grind, $500,000 of active business income could benefit from the lower small business tax rate. After the grind, only $200,000 qualifies. That means an additional $300,000 of active business income is pushed into the higher general corporate tax rate. And this is where the extra tax comes from. Notice something important. The construction business itself has not changed. The company is still building the same sunrooms. It's still constructing the same decks. It's still serving the same customers. Its active business operations remain exactly the same. The increase in tax is not caused by a change in business activity. It's caused by the corporation's passive investment income. The investment portfolio generated enough AAII to reduce access to the small business deduction, and that reduction forces more active business income to be taxed at the higher general corporate rate. This is the central lesson of the entire passive income grind regime. The government is not directly taxing active business income at a higher rate because the business became more profitable. Instead, the government reduces access to the small business deduction when passive investment income exceeds certain thresholds. The result is indirect but powerful. Passive investment income can increase the tax burden on active business income, even when the business itself has not changed at all. And that's exactly what happened in this example. Shine Sunrooms Decks Ltd earned passive investment income. That passive income created adjusted aggregate investment income. AAII triggered the grind. The grind reduced the small business limit. And the reduced small business limit caused more active business income to be taxed at higher corporate rates. If you understand that sequence, you understand the core concept behind the entire passive income grind system. And that brings us to the final takeaway. The passive income grind does not directly tax active business income. Instead, it reduces access to the small business deduction, which indirectly increases the tax paid on active business income. That single concept is the foundation of everything we've studied throughout this topic.